The green number on your screen this morning feels like information. It is not. It is a costume. SpaceX just priced its IPO at $135 a share, the largest offering in history, and somewhere right now, a disciplined investor who reads balance sheets and avoids hype is refreshing their brokerage app, heart rate climbing, wondering whether they are making a mistake by staying on the sidelines. That feeling is not a signal. Morningstar spent a decade measuring exactly what that feeling costs. Over the 10 years ending December 31, 2024, the average dollar invested in U.S. mutual funds and ETFs earned 7.0% per year. The funds themselves returned 8.2%. The gap is 1.2 percentage points annually. That is about 15% of every dollar of gain gone, not because the funds were bad, but because investors kept doing what you are doing right now, reading a green number and treating it as a fact about the future. If you are a self-directed investor between 30 and 55 managing your own portfolio and you have ever felt that pull between your spreadsheet and your gut, this is not a discipline problem. It is an architecture problem. The system is designed to make urgency feel rational. The math behind that feeling is uglier than the headline number suggests. If you want to see how this plays out on a $200,000 portfolio over a decade, stay with me. This channel exists to decode the financial systems designed to be confusing. If that sounds like a fair trade, subscribe. Now let us talk about what that green number actually is. There's a name for the mechanism. Two names, actually, and they stack on top of each other. The first comes from Amos Tversky and Kahneman. In 1974, they published a paper in Science called Judgment Under Uncertainty, Heuristics and Biases. The finding that applies here is anchoring. When a person is given an arbitrary starting number, even one they know is random, their subsequent estimates drift toward it. They cannot fully escape the gravity of the first number they see. The opening price of a hot IPO is not random, but it functions the same way. The moment SpaceX flashes a number about 135, your brain registers that number as a reference point. Everything below it starts to feel like a discount. Everything above it starts to feel like confirmation. The anchor is set. Your analysis is now downstream of it. The second mechanism is what Tversky and Kahneman described in their 1979 paper in Econometrica, Prospect Theory. The key parameter is lambda, the loss aversion coefficient. The classical estimate is 2.25. That means a loss of $100 causes about 2.25 times as much psychological pain as a gain of $100 produces pleasure. In plain terms, missing a pop that you watched happen hurts more than twice as much as capturing the same pop would feel good. The fear of missing out is not a metaphor. It is a mathematically documented asymmetry in how your brain weighs outcomes. The system does not need to deceive you. It just needs to show you a rising price at the right moment, and your own neurology does the rest. You already knew both of those things conceptually. The reason they still work on smart investors is the third layer, and this one comes from Robert Shiller. In 2017, Shiller delivered the presidential address to the American Economic Association. The paper became NBER Working Paper 23075 and was later published in the American Economic Review. The title was Narrative Economics. His argument was this: stories spread through populations the way viruses do. They mutate, they find hosts, they replicate. And a sufficiently viral financial narrative does not just describe a price, it justifies it after the fact. The story around SpaceX right now is rocket launches, Starlink satellites reaching 10.3 million subscribers, Elon Musk, Mars, the future of human civilization. That is not an investment thesis. That is a narrative that has achieved escape velocity. It is contagious. And Shiller's point is that contagious narratives have real economic consequences precisely because they are contagious, not because they are accurate. Anchoring sets your reference point. Loss aversion makes staying out feel like pain. Narrative gives you the intellectual permission to act. 3 biases, 1 green number. The result is what I call the urgency signal. That specific feeling that this particular moment requires a decision, that waiting is itself a choice you will regret. The urgency signal is a product. The green number is the packaging. Here's what that product actually costs. Imagine a bar. It represents your portfolio, $200,000. Now imagine that bar over 10 years. Compounding. If your money earns 8.2% annually, the rate the funds themselves returned over the last decade, that bar grows to roughly $439,000. That is the number the fund company shows you in the prospectus. Now watch the bar shrink slightly, not because the market did worse. Because you made 12 decisions over 10 years that the data says most investors make. You chased the sector rotation. You trimmed before an earnings report. You added to a position after a pop. Each decision felt rational in the moment. The aggregate effect is you earned 7% instead of 8.2%. The bar stops at $393,000. The gap is $46,000. $46,000 did not go to fees. It did not go to taxes. It went to the timing gap. It is the price of treating urgency as information. Now I want to be precise about what that number is and what it is not. The $46,000 figure comes from applying Morningstar's measured gap 1.2 percentage points annually to a $200,000 starting balance over 10 years. It assumes the gap is steady, which it is not in any individual year. Some years you beat the fund. Some years you trail it worse. But the direction over a decade is consistent, and the mechanism producing it is exactly the mechanism being activated right now. This is where I want to steel man the opposite view, because there is a real argument for acting. The strongest case for buying SPCX today is structural. Starlink is genuinely profitable. $11.4 billion in 2025 revenue, 63% EBITDA margin. The subscriber base roughly doubled in a year from 4.5 million to 10.3 million. MSCI fast-tracked inclusion starting the day after listing, which means index funds tracking those benchmarks are required buyers regardless of their view on valuation. A 4% float with forced index buying creates a mechanical floor that has nothing to do with investor sentiment. If you got an IPO allocation at $135, the short-term mechanics arguably favor holding. That is the legitimate case. It requires those specific structural conditions, and most investors today are not buying at $135. They are buying into the open market auction where all that demand has already expressed itself in the price. The fundamental math is harder to dismiss. At $1.75 trillion in market cap against $18 billion in 2025 revenue, the price-to-sales ratio was roughly 93 times. That is not a valuation. That is a vote of confidence in milestones that have not yet produced profit. The company posted a net loss of $4.94 billion last year. The XAI segment alone lost $6.36 billion. Nasdaq's own historical data shows that 3 years after their IPO, almost two-thirds of IPO stocks underperformed the market. 64% trail by more than 10%. Unprofitable companies with stretched valuations are in the worst-performing cohort of that data. None of that means SpaceX fails as a business. It means the stock, bought today by someone who missed the allocation and is chasing the pop, carries the full weight of a narrative that has already been priced in. The system is not stupid. It does not lie to you. It shows you a real company with real revenue and a real launch manifest and a story that is genuinely extraordinary. What it does not show you is the difference between the company and the stock, between the business and the price, between the narrative and the return. Shiller's point is that we are wired to conflate those things. The urgency signal feels like information because it arrives packaged inside a story you already believe. So what is the protocol? Step 1 is to run what I call the timing audit before any reactive trade. You open a blank document and you write down 3 things. What you know about the business, what the current price implies about future growth, and what specific new information arrived today that was not available last week. If the third item is a green number and a rising chart, that is not new information. That is recency bias wearing a press badge. The price moved. Your thesis did not change. A price move is not a thesis. Step 2 is to measure the gap you are actually working with. Pull up your account and calculate your dollar-weighted return over the last 3 years. Most brokerage platforms show this. Compare it to the simple buy and hold return of a total market index fund over the same period. If your number is lower, that difference is your personal urgency signal cost. It is concrete. It is yours. It is more useful than any IPO analysis you could do tonight. Step 3 is what Morningstar's data points toward directly. Automate the boring half of your portfolio. The investors with the smallest return gap are not the ones who made the best calls. They are the ones who made the fewest calls. Allocation funds, diversified and hands-off, trail their own returns by just 0.1% annually, compared to 1.5% for sector equity funds. The gap shrinks in direct proportion to how much discretion you remove from the system. Set a scheduled contribution. Set a rebalancing rule. Take the decision out of the moment where the urgency signal lives. Here's the reframe that matters. The $46,000 is not a number. It is approximately 2 years of working converted from optional to mandatory. It is the difference between a portfolio that funds a decision and a portfolio that demands one. Every time you act on the urgency signal, you're not just making a trade. You are extending the period of time your financial life requires your active management. The cost of chasing SPCX today is not measured in the spread between your entry price and where the stock closes 3 months from now. It is measured in the cumulative drag of a decade of decisions that each felt justified and each shaved a fraction off the return your money was already generating on your behalf. The green number is not wrong. SpaceX is a real company. The mission is real. The technology is real. The narrative is powerful precisely because it is grounded in something true. That is what makes it effective. Shiller's viruses spread fastest when they carry a kernel of legitimate information. The question is never whether the story is true. The question is whether the price already knows. If you are between 30 and 55 managing your own money, and you have ever beaten the market for a year, and then given most of it back the following year, you have already experienced the urgency signals cost firsthand. Drop a comment below. Tell me what the trade was and what it actually cost you in your annual return. I read every one of those, and the patterns are more consistent than most people expect. If this framework shifted something, share it with someone who is staring at their brokerage app right now. It might be worth more than anything they are about to buy. I'm Caspian. This is the Paycheck Lab.